All the initials after my name confirm that I am, without a doubt, one of the biggest nerds you will ever meet. For purposes of this presentation, I'm the author of a book called U.S. Captive Insurance Law. This is the leading text in the area of captive insurance. I'm very excited about a couple of developments here. We have a second edition coming out in about 6 to 8 weeks. A law professor out of John Marshall named Becca Cantley will be adding an entire section on modern compliance issues related to captives. And we are already talking about a third edition, which will look at some of the recent developments.
So you've got a textbook opportunity with other law schools as well?
Yep. Yeah. I also author a book called Should You Form a Captive Insurance Company? This is published in conjunction with the Tax Analyst website. If you all need to contact me after this presentation, if you're like me and once the presentation is over and the guys left the room, you think of 14 questions you want to ask, Carl's got my number, or if you want to write it down, it's 832-330-4101. The purpose of this presentation is to explain about captive insurance. And first of all, we're going to talk about why would you do this? That is, what is the attraction to this particular transaction? Next, after that, we're going to talk about the actual formation process. That's the steps involved to the soup to nuts. Finally, we're going to cover the legal history of captives very generally. I promise not to bore you all with a lot of intimate details. But if you've done any due diligence on captive insurance, you've learned that the IRS and taxpayers fought a fairly heated battle for about 30 to 35 years. By the way, the IRS lost. Which is why we can do this today. So let me start. What is this? Okay. Well, in the case law, a captive insurance company is defined as a wholly owned insurance subsidiary. Okay. In layman's terms, you're going into the insurance business. You can now realize your lifelong ambition of becoming an insurance executive. Well, why would you do this? Well, in the normal insurance transaction, you pay your premium to an insurance company. I have been very particular about using that graphic on the far right of the screen of an individual placing money into a piggy bank. If you look at the balance sheet of most of what I call third-party insurers, Allstates, Travelers, et cetera, they make money hand over fist. Okay, so short version, you're fattening their bottom line. By going into the insurance business, you're cutting out the middleman. Your company pays a premium to your captive. You keep the money. Okay? Simply put, this is a great business decision and a great business opportunity for your company. AM Best recently published that captive insurers are outperforming their commercial counterparts on every key financial measure. When you look at a captive from the standpoint of a financial operating company, you have better margins, you have much better returns, your return on assets is phenomenal, your return on investment is absolutely phenomenal. Now, that leads to the question of how did we get here? That is, how did this particular transaction develop? Well, it's easy to think that we can always call our insurance broker and say, hey, I need coverage for X. And they'll call us back in 10 to 15 minutes and they'll say, hey, it's going to cost you X. Actually, that's not the case. Starting in the 1950s, certain types of businesses discovered one of two things. Either A, I can't find coverage, or B, I can only find very expensive coverage. The case law, the first two companies to form a captive, even though the term wasn't used in the case, I call them the floodplain cases. Two companies owned property in a floodplain. The river had recently flooded, so simply put, they could not find coverage. So they were forced by business necessity to form a captive insurance company. Oil and gas industry was a big mover in this. One of the earliest cases involved a company that was involved in offshore oil exploration. The only company that could insure them was Lloyd's. Anytime you hear the word Lloyd's of London, immediately think literally the most expensive insurance coverage on the planet Earth, because that's what they ran into. Large manufacturers. Stearns Rogers basically built giant manufacturing facilities. So when they had to show proof of insurance to bid on projects. Eventually they were priced out of the market, so they formed an insurance company to provide their own coverage. And the Humana hospital chain. In the late 60s, they almost went without insurance. And the reason why was they were priced out of the market. Anybody here a lawyer aside from myself? Okay, good. In the 1970s, the insurance industry was sued under 4 causes of action: asbestos, professional liability, specifically medical malpractice, environmental claims, and products liability. The sum total of all this is that a lot of insurance companies either went bankrupt or had major payouts. For those of you who watch television, you've seen the do you or a loved one know of anybody who had asbestos covers? There's now a $30 billion trust fund established for that. Guess who created that trust fund? Insurance companies.
Hale, is that when the explosion of plaintiff attorneys and personal injury?
1970 is the height of the plaintiff's bar. Okay. Starting in the 1970s, out of reaction, the insurance industry basically starts cutting back on insurance coverage. So as a result, what we do is cover the risks that are not part of your insurance coverage. Out of curiosity, how many people here have a business and have insurance through it? Okay? How many people here have read their insurance policy from the first page to the last? Okay. The bottom line is your policies have lots of exclusions, okay? Now, most businesses have either a commercial general liability or property policy, okay? Some people combine that into what's called a business owner's policy. But these policies have known exclusions. The commercial general liability policy, employment claims and employee fidelity. If an employee sues you for wrongful termination, you're not covered. Your employee takes money from you, you're not covered. Cyber risk, this is a huge issue. Starting with Target's disclosure in the 4th quarter of last year, we have learned that U.S. cybersecurity, for lack of a better term, doesn't really exist, okay? Just disclosed that JP Morgan, 76 million customers, okay, had their data hacked in one form or another. In Target's 10K, the document that they have to file with the SEC, they have a $100 million cyber liability policy with a $10 million deductible. Okay, $20 is they're going into captive business now because no one's going to cover them anymore.
But you said cybersecurity just doesn't exist.
Well, think of the hacking that we've had.
Yeah.
The Chinese have come in through the back door through numerous companies. Home Depot just announced that they had a huge data hack. Something similar to what happened with Target. I mean,
while we're talking about, let me mention that.
Sure.
I just sent an email to Linda to fire out a client alert. This has been verified through Snoops and other resources. It was just on Fox News. The application you install on your cell phone for a flashlight,
Yeah.
The top 10 of those have been manufactured by China or Russia or evildoers, where when you install that application, it gets into your cell phone, which gives them access to all of the stuff that you're doing
That's
on
the
your cell
flashlight
phone.
application?
Yeah, so you should have.
Get deleted when this is over.
Yeah, the solution will be emailed out, but you basically delete it, go by the store and have them factory reset your cell phone. But that's an innovative backdoor way. Whatever applications have these Trojan horses in it, but cyber risk is huge.
It's huge.
Yeah.
And if the U.S. insurance industry does what they usually do, anytime there are a lot of claims, they do 2 things. First of all, they sit their lawyers on you. And a great example of this, I put together a captive for a company up in New Jersey. They were hit by Superstorm Sandy. Their property policy had a loss of income rider, standard addition to an insurance policy. But they filed a $280,000 claim for loss of income for a month, for a week's lost revenue. But there was a clause in there that said if it was caused by a utility problem, then their maximum payout was $25,000. So what did the insurance company argue? Oh, it was caused by a utility problem. And simply put, it's easier to take the claim than litigate the damn thing. For people who make products liability, products recall. Somebody sues you under products liability, you're excluded. Product recall. And do a Google search for product recall. It happens a lot more often than you want to admit. Loss of key contract, loss of key person. A number of businesses get 50% plus of their revenue with one client. It's really common in the oil and gas industry. where an engineer from Exxon will spin off, basically form a consultancy, and still get 70% of their business from Exxon. But the bottom line is that it's just they like being their own boss. Property policies, pollution. There's a company called ISO that makes all the insurance policies that we all use pretty much. There is an exclusion called the total pollution exclusion. Okay, I dub that the don't even think about trying to file any kind of pollution claim under this policy. Mold remediation. Anybody remember about 10, 15 years ago, this was a huge issue in Texas, okay? Because we over air condition, et cetera, we have these giant mold factories in our attics, et cetera. And this went to a lot of litigation in Texas. Flooding. I've got a couple of clients who own commercial real estate, one in Florida, one along the Texas coast. Flooding is typically excluded, or they have a very high deductible. Lesser of $50,000 or 5% of the property, or greater of that. Windstorm deductible, that also applies to hurricanes. And we also cover some other risks. Statutory change. What happens if the law that governs your industry changes and you have to expend money to comply with it? Financial services, Dodd-Frank, okay? The Obamacare has done a lot, has forced doctors to do a lot of different stuff. Administrative actions. Let's suppose that a regulatory body that has the ability to bring you into court, et cetera, does so. We can cover that. Loss of license, accounts receivable coverage, legal expense. By far, the policy most often triggered. Just the cost of hiring an attorney. Even though most policies have a legal liability rider as part of it, the insurance company still has backdoor control over it. Okay, so you can't really hire the attorney that you want. So let's sum up so far. For most of you guys, insurance is a fixed cost. Why not go into business yourself and make the money yourself? With a captive, you form an insurance company, you provide coverage for risks that aren't covered in your current policies, and you pocket the profit. Now, some of you all may know who Warren Buffett is. He happens to be a somewhat famous investor. He calls insurance a license to print money. And the reason why is it is. Insurance companies, when they're done properly, are fabulously productive. What are some of the other benefits of forming a captive? Being an attorney, the ability to write a document, it gives me carte blanche. Okay, so long as I don't write anything illegal or violate basic industry practices, I can write whatever I want in the contract. Sometimes it's really hard to explain what a great and fabulous benefit it is. Just as an example, go home and read one of your insurance policies tonight. Okay, really. And first of all, if you have insomnia, you'll cure it in about 10 pages. But more importantly, that policy is not written with you in mind. That policy is written by the insurance companies for the insurance companies. Theoretically, there's a legal doctrine. It's called adhesion contract. Whenever one party to a contract controls the drafting, the terms of the contract are supposed to be interpreted against them. Great theory and practice. Great theory, but not exactly the most widely used doctrine in the courts. You get broader insurance coverage. Captives create what I call an insurance tapestry. Unless you're a Fortune 500 company, we're going to keep your big policies in place, and we're just going to fill gaps in coverage. Basically, what we're going to cover with a captive is what's called a stochastic risk. Low frequency, higher payout, okay? The big insurance companies, I call mutual funds with an annuitized cash outflow, okay? The point I'm trying to make there is that the big companies, they would rather manage their investment portfolios. They want to know to a dime what they're going to pay out every year. So they only underwrite risks that they really have a very high understanding of. So for example, if you ask an actuary how many houses in Houston are going to get hit by lightning this year, they'll say, between 25 and 27. And chances are they're probably pretty close. Ask them how many lawsuits are going to be filed in Houston. Not a clue. So as a result, they cover the former, but not the latter. Custom programs. I was having a conversation with a client earlier today. The idea of risk management is a new concept for a lot of people. Okay, but typically what happens is a business owner gets to roughly the $1 million revenue level. And suddenly, not only do they want to grow, but they want to begin to protect what they have. And that's when they start looking at insurance policies. And that's when they start saying, you know, if this happens, I've got problems, okay? For example, I only have 5 suppliers who supply my raw materials. I tick one of them off, the rumor grapevine starts, and suddenly I have a hard time getting material, or I just get bumped down the line a little bit, okay? They start to realize that there are these risks out there, and they want to provide coverage for them. And that's where we kick in with the captive. Now, let's look at forming a captive. For those of you who are thinking about doing that this year, or for whom you think this would be a good business prospect for your client, we can still get a lot done. Okay, the last captive I formed last year, I got all the paperwork in on December 13th. Trust me, we did a lot of crazy work, but we still got it done. The first step is the writing of what's called a feasibility study. Basically, this is a business plan for the captive, okay? We're going to outline the program. We're going to explain some of the regulations to the client, okay? Sometimes you'll run into internal resistance in an organization. What typically happens is somebody inside the organization didn't come up with the idea, so they get angry at you for coming in. The feasibility study can also help to overcome internal resistance in the program.
For you, is the captive, when you're doing that process, do you have to align or be approved by the insurance commission or anything?
That's already done.
That's
Yeah,
already done.
the process, the second step in doing that, and there's actually two sets of documents you have to file. One is called a biographical affidavit, okay? Short version, as part of the application process, they're going to do a background check. They want 10 to 20 years of residential and professional history. 2 key issues here. One, have you ever been convicted of a crime of moral turpitude? Lying, cheating, stealing. If you have, don't waste my time because you won't get approved. If you've declared bankruptcy, now I've gotten captives approved for people who declared bankruptcy up to 10 years ago or longer, okay? If it's closer in proximity to the date you're forming, it may be an issue, okay? Finally, we have to basically submit the feasibility study that we wrote. This will contain assets relative to risks, the experience of the people involved, the soundness of your kinds of operation, any loss prevention programs, and anything else the regulator thinks is important, okay? Now finally, there's the issue of original capital and surplus. Every captive has to have at least $250,000 of base capital and surplus. Sometimes if we use a structure called a series structure, we can lower that amount, but that's very much a facts and circumstances answer. In running the captive, you're going to need a number of individuals. A domicile manager and legal counsel. And these are 2 services that I provide. Audit and accounting, actuarial services, and an investment manager. Now finally, there are basically 7 reasons given in statute why a regulator can shut you down. Let's kind of cut through all the facts and explain what they are. You break the law, you place the captive into some kind of financial jeopardy, or you violate your own operating guidelines, okay? Bottom line, run the captive like a subsidiary of your business and keep it solvent and don't screw around with it and you're fine. Now, let's look at the legal history. Starting with Revenue Ruling 63-177, the IRS said we're going to challenge captives. They did so for 30 years. They used 3 arguments: the economic family argument, the nexus of contracts, and assignment of income. Nexus of contracts and assignment of income, they only advanced in 1 case each. Nexus of contracts is this fairly highbrow ivory tower theory of what is the true legal nature of the corporation. I won't bore you with what's involved. The assignment of income case was extremely fact-specific.
Was there political pressure during that time?
Actually, no. I'll get to this in the next couple of slides. The IRS actually had a very legitimate reason for challenging captives. a lot of times we think of the IRS as just like the enforcement arm and like the Gestapo, etc. There were actual real legal issues that had to be resolved in the courts. Now, no court accepted any of these arguments, okay? The IRS did win the first set of cases. The 1970s to early 80s. Why? And this gets to what we're talking about here. They're better prepared. The taxpayers put on really horrible cases. And there is a lack of a solid insurance definition. We think that, insurance is this bedrock concept of capitalism that's been around forever and a day. Actually, legally, starting with the cat litigation, we really didn't know what the legal definition of an insurance company is, okay? There was a case in 1943, Helbring v. Legiers, that said insurance involves risk shifting and risk distribution. That's all the case said on that. So it was left to later cases kind of flesh that one out. The IRS used that to their advantage, okay? But starting with the Humana case in the late 1980s, the taxpayers won most of their cases. One, they were better prepared. One taxpayer went so far as to hire an expert witness named Joseph Stiglitz. For those of you in the economic world, he's a Nobel Prize winner. The guy's a genius. The IRS's argument starts to unravel. Very briefly, the economic family argument, when you read the internal memorandums that the IRS assembled to quote-unquote support their theory, doesn't really hold water. They hint at a couple of supporting doctrines, they hint at a couple of supporting ideas, but they never really develop it. So as a result, once you really start to challenge it in court, it falls apart. And courts become more sophisticated. One of the fascinating things about the IRS litigation is that the courts at first are like, well, what is insurance? The IRS says it's risk shifting and risk distribution. The courts say, great. By the end of it, they're talking about law of large numbers. Okay, they're talking about risk distribution from an actuarial perspective. They're really getting into the nooks and crannies of what we would now consider to be an insurance company. As a result, we now utilize what are called safe harbors. A safe harbor is exactly what it sounds like. If you're going to do this, here is how you do it. Harper, which is a test case in 1994, gave us a three-pronged test. Does it involve insurance risk? Is it insurance in its commonly accepted sense? And does it have risk shifting and risk distribution? Basically what the court is saying here is, okay, what does an insurance company look like? What would it have to comply with? And these are the factors it came up with. I call this the duck test. Does it walk and talk like an insurance company? Okay, it's really not that complicated. Next, the IRS issued several what are called revenue rulings. Aflac, I know. I try and not get to that joke. It just kind of sits there. And
do it. It's hard to duck it though, isn't it?
Two revenue rulings give us two potential options to create risk distribution. A, we get 50% of our insurance revenue and risk from a third party, or B, we have at least 12 subsidiaries to have sufficient risk distribution, neither comprising less than 5 nor more than 15% of the total revenue.
All this is actively monitored and everything?
Interesting you bring that up. No, it's not. Right now, starting about 2012, late 2000, last 2 years, the IRS has been targeting certain captive providers. What are they doing? Here's my theory about what happened. The IRS issued these revenue rulings in 2002, and to use a fishing analogy, they've let the industry run, okay? Along the way, they've now started to say, we don't like this practice, or we don't like that practice. The other problem is that captives, at the end of the 1990s, beginning of the 2000s, there's a huge clampdown on tax shelters, okay? We had the codification of the economic substance doctrine in 2006. We had some very aggressive litigation on the part of the IRS. The short version of all this is that a lot of people who were involved with tax shelters went to 412I plans, captive insurance, etc., as another way to quote-unquote do tax shelters. What's unfortunate about this is that when you look at the case law history of captives, Captive started because of business necessity, okay? And that's one of the things that I find so absolutely fascinating about this area of law. Go back to the beginning that we talked about earlier, okay? I can't find coverage. I need it, okay? I own property in a floodplain. It flooded 10 years ago. No one's covering the risk. I like having my business here for legitimate reasons. I need coverage, okay? I want to develop oil offshore. You know, the only people that are covering that risk is Lloyd's. On and on and on and on and on. It started basic capitalism, okay? The market was not providing a mechanism to ensure the risk. Businesses saw it out and did it. To get back to the question, actively monitored, it's currently being monitored more, okay? There's 2 litigations that I know of going on. Chances are there's more going on out there. You know, it's like anything else. The rules are actually very clear. They're very straightforward. Don't run afoul of them. In the last year and a half, I found it being a lot more conservative in the way I do things, and nothing wrong with that. I turn down about half the deals that come my way because they don't seem to be about risk management, but they're more about tax savings than anything else. But the bottom line is that over 30 states have captive insurance statutes on the books. There are 5,000 captives in the U.S. Within the next 10, maybe 15 years, all states will have a captive insurance statute because they're missing out on business. Okay, an entire industry has now developed around this. They're not going to take it away.
How does a captive only get? Where do they get the other 50% of the revenue?
Oh.
They can't do it themselves.
To comply with rule number 1, we participate in what are called captive insurance risk pools. Okay, short version, it's like a poker table. Okay, beginning of the year, everybody ponies up $10 and they get $8 out. Okay, the $10 that I pay represents my paying the pool for some reinsurance for my captive. The $8 I get back from them is the pool saying, okay, we're going to send some of our risk to you. That's the way we comply with that.
Is this a freestanding entity that represents different companies then?
Yeah, it's a pool.
No one company can have their own captive.
One company can't, it's big enough. And that gets into,
Yeah.
the rule of 12, there's also the rule, that's actually been dropped down to roughly 9 if you have 9
It's almost a
subsidiaries.
co-op.
To a certain extent, yeah. The problem with the rule of 12 as it's written is it outlines a scenario that I have never seen, it doesn't exist. 12 subsidiaries, revenue and risk equally distributed among them. Doesn't happen, okay? What the IRS basically is saying is, we want to see some diversity of operations. If you're a company and you have a national presence, and you've broken your company down into West Coast, Midwest, Northwest, South, whatever, and you've got 6 or 7 different divisions, and there's a lot of risk in all this, like Rent-A-Center did this, okay? There's not going to be a problem, okay? Bottom line. If you're a smaller company, you'll probably have to at least get partial risk pool coverage. And in that case,
They have
it's
to be in
really,
the same industry?
pardon me?
They have to be in the same industry?
No, same risks, okay? You have to do the pair of risks off. Okay, so if I've got 7 captives and all 7 are underwriting legal liability, when I send my money into the pool, I'm sending some of my legal risk to the pool, I'm getting some of the pool's legal risk. Finally,
Get one quick,
sure.
because I didn't, you just
That's
now
okay.
dawned on me, this is
Sure.
not, captives seem to be the company owns their own insurance agency.
Huh?
I'm sure they can't. But how do you, if I have a company and decide I'd like to do that, how do I find other companies that want to join me?
Well, that's what I do with the risk. I've got my own risk pool now, so I handle that. If you need the risk to distribution, then I handle that one. Forming a captive with other, okay, very generally there's single parent captives, a pure captive that only insures the business of its parent. Then there's a group captive that insures groups of companies. Group captives are really cool in theory, but they're really difficult to implement. Typically, they only work in 2 scenarios. A, you're forced to form an insurance company with your competitors. Good example here is NEIL, Nuclear Energy Insurance League. Shock of the new, nuclear power plants cannot find insurance. So they form their own insurance company, NEIL. There's one offshore Bermuda called oil. What industry does that one serve, guys?
Yeah.
Industries that have risks that can't be covered, they're forced to do it. The other is companies or people who are already working together. For example, a doctor's practice, you've got 12 doctors, and they've all been working together in some capacity for 5, 6 years. putting together an insurance company that covers them for med, mal, loss of license, and that kind of stuff, that's a lot easier to do because they're already working together. There are people who are great at aligning interests of people. They're playing the political game, and hey, John, you should meet Ed, and you should form a captive. I am not one of those. You can. The trick with health insurance, pardon me. Okay. The tax code splits insurance companies down the middle. There's life and there's property casualty. Life means you're insuring people. Property casualty means you're insuring things. The rules for both of them are pretty similar except for issues related to reserving, etc. The problem with the health insurance captive, a P&C captive, I can show you financial savings in 10 minutes. I got the spreadsheet on my computer, okay? With the health insurance captive, it's a much more complicated transaction. To save money, the company has to be committed. And by committed, I mean, for example, they've got 100 people. They have to be willing to institute a wellness program. Okay, they have to be willing to do what it takes to lower the demand for health insurance from their people. If they simply put the captive together and don't do anything else, it's not going to be a great operation. Now, if you have a company that's forward-thinking and they do a lot of that really soft, squishy HR stuff, bottom line, then this is a fabulous opportunity because they can lower healthcare costs between 10 to 20% over a 3 to 5 year period, capture that savings in the captive, largely by decreased usage of health insurance. But they have to be very proactive, okay? Very, very proactive. And again, the whole issue of wellness really comes into play. If they're willing to do that, go for it. Great opportunity.
They also have to be pretty tough. In other words, they need to be able to say to their employees, they decide not to cover some drug,
Yeah.
and the employee comes back and starts complaining. It's always been, oh, well, that was the insurance company's fault.
Yeah, and now it's wait a minute, I am the insurance company.
That's right.
I'm just not a nice person.
And so it's really tough. I mean,
Yeah.
I think that whole barrier is something that keeps that certain size companies out of it.
Yeah, a lot of people love the idea, but the bottom, a PNC captive, once it's up and running, I tell people, how much do I have to be involved? A couple times a year, unless there's a claim. I mean, it's a self-running company once you bring the pros in.
But you gotta bring a TPA in.
Yeah, and that's the whole issue, is you have to set everything. It's a much more complicated, much more involved process. Plus, with a captive, an 831B captive, which is what we've been talking about here, in terms of the I can get one for a company, I can get one up and running for a company, roughly $1 million in gross income, or free cash flow of $250,000 to $350,000 for the last couple of years, okay? But the healthcare captive, like minimum 50 employees, and frankly 75 is, I know people that can do it at 50, but 75 is really where it starts to make sense, so it's the bigger companies.